Master in to talk about, the markets from here. Nilesh Shah is Managing Director and Chief Executive Officer at Envision Capital. He's with us here in our studios. Nilesh, thanks for dropping by.
Thank you, Prashant.
Great to have you. So, what's the mood like? What's the picture like? Picture badal gayi thodi si last night, or not really? What's your sense?
The picture reinforced ho gayi hai. I think the uptrend was pretty much intact.
Okay.
I think India has demonstrated some really strong performance, both as a market. I think corporate earnings have been phenomenally strong. They have been better than expectations across the board, across sectors. That has been very strong. I think I was in the US and I've just come back from the US, and I think the investors there are taking cognizance of the macro stability which India is demonstrating. The fact that with crude rearing its head, despite that we still have inflation only at around 5%. And growth still continuing at around 7%. I think the world is beginning to take notice of that. So I think on the whole, I still believe the uptrend is pretty much intact. We may have some bit of speed breakers here and there, but otherwise, I don't see any significant or material risk to this uptrend.
You must have read the Akash Prakash piece, the weekly column, in which he kind of sort of outlines his feedback from a lot of meetings he had with global asset allocators. Pretty much echoes what you also have heard from people, that there is a lot of money waiting to get into
absolutely.
This is not near term, but this is there. It's there.
Prashant, I think still India is not yet a country-specific allocation. Unlike China, South Korea, where there are country-specific allocations in Asia, I think versus that India is still kind of part of some regional allocation, some EM allocation. And my view is that if over the next 6 months we have a higher certainty post the election outcome, you're going to see kind of inflows into India which we have not seen in the past. That's the kind of money waiting in the wings out there. And that to me is, I think, again, a huge positive. There's, of course, the strong domestic liquidity, but I think that's what international investors are waiting for. And if the event is out of the way, clearly you're going to see significant amount of liquidity come in.
So you're basically saying that the stage is set, there are all the lights on the stage itself, but just the performers are waiting in the wings, and once the curtains are open, post the elections, everyone comes and it's a big party.
Oh, absolutely. I think of course it's going to be a bit of wait and watch for the next few months, because obviously crude is the big variable, what's happening in West Asia is the next variable, and third, of course, is our own set of elections back home. That, I think, is the only thing which is keeping investors holding back.
So, just wanted to know, from an absolute valuation perspective, we're not too far away from the averages that we've traded at. But a lot of pockets are seeing a lot of overvaluation. Some of them are undervalued. What are your thoughts on what parts of the market currently look expensive and what are the places which offer value?
So what looks expensive is clearly the EMS space, the electronic manufacturing space. I think it's fine for stocks to be expensive and to probably be perceived as overvalued as long as there is delivery. I think the challenge with the EMS space is that I think expectations are running very high and there isn't kind of a corresponding delivery happening out there. That to me clearly looks a bit kind of expensive. But otherwise, I think the kind of consolidation that we have seen in pockets of the market, I think valuations actually have kind of come off. Look at the capex space. The numbers have essentially been very, very strong. But a lot of these stocks have corrected by maybe 10, 15, 20% in the recent months. Banks, again, financials, I think the performance has been stellar. I think it's hard to come across businesses continuously growing at 20, 25%, but stock prices not responding to those kind of earnings. So clearly banks, capex, clearly is a space where there is still probably a lot more upside. And the last space, I think, is the mid-cap, small-cap IT space, the tech space out there. And if you look at a lot of the individual companies, leave aside the top 5 or 8 companies. But after that, clearly the numbers have been quite phenomenal. And I believe that if the growth momentum sustains, I clearly think that will result into even stronger price performance.
Okay, all right. Hi, Nilesh. Good to have you in the studio.
Hi,
the
Nigel.
point you made on the banking names is quite important, right? But the big boy in there is not moving. HDFC Bank, what's the view? I mean, multi-year low valuations, the biggest component on the Nifty. You want your best batsman to go in there and perform, but that's not performing. Has the time come now to get into HDFC Bank?
Nigel, my view is that I think HDFC Bank could perform, and we own HDFC Bank, I think could start to outperform when that big bout of liquidity comes in. It's going to be driven a lot by liquidity. I think the problem with HDFC Bank right now is a problem of relative performance. couple of years back, 3 years back, in its heydays, it was probably the only bank which was delivering consistent performance.
Right.
The rest was still struggling with repair. They were struggling with asset quality and all of that. Today, you've got at least half a dozen or a dozen other banks, financials, NBFC, specialized lenders who are delivering performance which is even stronger than that, who are delivering 20-25% growth, inching up their return on equity and maintaining their asset quality. And I think as long as that continues, I think HDFC Bank may continue to underperform. It's more a challenge of relative performance of others. But my sense is when you see big liquidity coming in, that's the time. And by that time, the woes of HDFC Bank in terms of its merger and a larger balance sheet, all of those, I think those woes will be behind it.
Okay.
You know, so let me go from one end of the spectrum. HDFC Bank is about 25 lakh crores in a book, and you own Home First, right?
That's right.
Which is in the other spectrum.
Yes.
And that is, I think, also sometimes the base matters, right? In terms of what growths you can achieve.
Yes. Yes.
7,000 crore assets.
Yes.
Growing very fast. We spoke with the management recently.
Yes.
I mean, sounded pretty confident. 30% growth for at least the foreseeable future.
Yeah, absolutely. I mean, that market for affordable housing is still so underpenetrated. And within that, the share of Home First is probably not even 1% or so. So the headroom for growth is quite phenomenal. You have sufficient capital to grow. You have scope for your credit rating to improve as you get bigger and preserve your asset quality. And on top of that, if you grow at 30% and if your ROE keeps inching up, that becomes an extremely compelling case for a further re-rating. So I still think it's a great compounding opportunity for a very long period of time. I think we have to kind of remember that there was a group finance earlier on, which there were many housing finance companies at that point of time, including HDFC, the big boy, and then many of the other wannabes like PNB Housing Finance, all of that. But even in that environment, group finance just became a huge rallying point for the sector, and it ended up becoming the world's most expensive mortgage lender. And I think one should keep that backdrop in mind, that maybe Home First has a chance at that.
What could happen, right? In terms of the quality, etc., is pretty good.
I think when Prashant, you have the business itself growing at 30%, and you're trading at probably maybe about 3 times price to book, which is not awfully expensive. And you have ROE, which is inched up from maybe 10% to 15% in the last 2-3 years, and probably will head towards 18% in the next maybe 2-3 years. I think that's a great set of ingredients to have.
What else? I mean, I think you still own Polycab?
We own Polycab.
I mean, I think last time you were on, you talked about Stylum.
That's right. We own Stylum.
I think that was a recent.
That's
more
and
recent
Kolte
purchase.
Patel also.
That's right. We own Kolte Patel as
Yeah,
well.
cool.
And yes, and one of our most recent has been MapMy India, C-Info Systems.
How is that one doing? I mean,
They reported their earnings, I think, yesterday or day before. Again, phenomenal earnings.
We had the management...
revenues for the quarter growing 20%, margins expanding from 42% to 45%. Look at the kind of use cases that they have. It could pretty much be ubiquitous, which means that any sector, any space that you would essentially be dealing with on a daily basis, you could probably directly, indirectly touching MapMy India in some way or the other.
E-commerce is a big segment for them.
No, and
That's still kind of an optionality.
Right.
It's still very early stages. They're
autos
talking of
mostly,
selling
but-
Apple's gadgets and all of that kind of stuff. But those are all at very embryonic stage. I wouldn't kind of bet on that too much for the next 3 to 5 years. Maybe that's an opportunity which will unfold maybe 5-10 years later, because that's a hyper-competitive space.
Where is it trading at, though?
Valuations trailing 90 times, but it's a unique business. I mean, it's probably the only deep tech products and platform company.
They have a 1,000 crore revenue target by FY28.
Now, if you have a business, Prashant, which is growing at 30-40% with a 40% margin and with a 40% ROE, with longevity and enormity of the opportunity for the next 10-20 years, what more do you want as an investor?
And you think it'll compound at 30? Not the stock, but the earnings will. They've got visibility.
I mean, that's the guidance that they have dished out. That from 280 crores of revenues last year, they'll kind of targeting 1,000 crores by FY27-28. That translates into probably a 30-35% earnings growth. That's quite powerful.
You've been at the forefront of understanding the IT space, and now you're looking at deep tech. So should one believe that maybe the time for traditional large format IT companies that we know of, it's time for them to take a bit of a backseat? Maybe the mid-cap deep tech companies, new age technologies companies go ahead and show the next leg of growth, while these guys just grow at maybe what, global GDP or that EPS?
Absolutely, Mangalam. Absolutely. I think the days of the big boy IT companies is over.
Okay.
In the sense that they're not finished. I mean, they're obviously still growing and they'll be contributing to the economy in terms of jobs and all of that. But they'd probably be growing in low single digits, okay? Unless any of them transforms themselves and encashes or capitalize on the AI opportunity.
Do you see any of them doing that?
Not yet. Still very early days. I think we tend to overestimate in the short term and underestimate in the long term, but I think AI clearly is there. So I honestly don't know yet. But I still think that the underperformance will continue. At best, there'll be only valuation arbitrages, which means that when they veer towards the floor of the valuation range, they probably become good tactical buys, and when they go towards the upper end, they probably become
Isn't
exits.
the floor itself going lower structurally because of...
Unlikely as long as they remain capital efficient. Okay. I think it's rare to see businesses which generate cash flows and have capital efficiency north of 20-25%. That's great. It's like typically your large consumer companies, HUL, Nestle, all of them, they all grow in single digits but still report very high capital efficiency. And I think market respects capital efficiency. So as long as that is there, I don't think the floor will go down even further.
Okay, all right. Talking about consumption, I want to ask you about Mamaearth. I've seen some of those products at home. And luckily we have restrictions and, we're definitely not applying to the IPO. But what's your view out there? Because the street is divided. Some part of them believes that it's very, very expensive. Some are saying going ahead, this is going to perform. But at current reckoning, it's 100 times. So your take.
I probably think both the views are correct, which means short-term expensive.
But which side are you on?
No, I'd give it a pass right now.
Okay.
I think the business is great. Okay, I think the fact that it's become a 1,000 crore revenue company, the brands are selling, the products are selling, undoubtedly. Okay, and therefore in the next 5-10 years, this business is probably from 1,000 crores will become a 5,000, 10,000 crore revenue company. The big delta is going to come in from margins. Today, the margins are abysmally low or probably just don't exist. They probably just break even, or it's like 1% or something like that, 5%. Look at the margins of some of the other consumer companies, HUL, etc., 20-25% margins.
Yeah.
Even if these guys go to 15-18%, that's going to mean a lot in terms of earnings growth. But like most companies, they will disappoint somewhere along the way. The markets will have a reality check, like we saw for many of the new age businesses which listed in 21. In 22, they gave you a brilliant entry opportunity. I think Mamaearth will see something similar down the road. You'll have to just be patient.
They've kept some of their chips in the bag, 40% ad spends is what they do. And just before the IPO quarter, they shaved off 5% of that and their margins have become about 6-odd%. So there's a direct correlation there. So if they continue to do that and their revenue grows, then maybe some can look at better margins out there as well. But like you said, at some point...
I like the way you put it, Nilesh. Yeah,
I think,
anything else and anything new in terms of ideas, etc.?
No, nothing new right now. I think we just kind of focused
on... You
still
own PB Fintech?
Yes, PB Fintech we own. We continue to own PB Fintech. Yeah, that's right. I think it continues to be good. Of course, there are going to be some short-term headwinds. The industry itself is not going to grow as the pace at which it was growing in the past because of some of those tax-related changes. There are a couple of sources of competition coming from them. Bima Sugam, etc., are going to be essentially things to watch out for. But I think it's a fabulous business. The fact that you've held on to this high market share for so long, you're running the business in an extremely capital efficient manner. They plan to get into the reinsurance space. And PB Fintech is not just Policy Bazaar, it's also Paisa Bazaar. So if Paytm is growing at this pace, if the street is becoming optimistic on Jio Financial and Bajaj Finance, I think Paisa Bazaar is, a great optionality that they have certain, which I think is underrated right now.
All right, Nilesh, we'll leave it there. Great conversation. Thank you very much. And do drop in. I mean, we should have these interactions in studio. Add so much to it. Thank you very much for joining us.